rolling now. All right, so appreciate that, John. So definitely, want to let everyone know we appreciate them getting on the call today, to discuss tax strategies in the current landscape. So some of you may remember in the final weeks back in 2017, Congress passed the most comprehensive tax reform package in decades. It reduced tax rates for individuals and corporations, made modifications to many tax rules, including deductions. And then the bill represented the largest change to the tax code since President Reagan's Tax Reform Act way back in 1986. President Trump signed the Tax Cuts and Jobs Act into law on December 22nd of 2017. The broad changes meant that the law will impact individuals, estates, trusts, corporations, and also small businesses. While lawmakers initially sought to simplify the tax code, the final package was a little more mixed from that standpoint. Some provisions have been eliminated or simplified, while several other new tax rules were added. This law really fundamentally changed the overall tax landscape, at least until the end of 2025. So during our discussion today, we will examine the current tax landscape in detail, including income and estate/gift taxes. And then we'll go through actionable planning considerations that will be highlighted to help uncover potential opportunities that you can discuss with us as your financial planners or with your tax professionals and or your estate planning attorneys as well. All right. Here are the topics for discussion today. First, we'll start by reviewing the landscape. Then we will highlight specific actionable planning ideas to consider, really in collaboration with a qualified, again, tax professional or estate planning professional. All right, we'll start with the better understanding the current landscape. So currently, taxpayers benefit from a favorable tax environment from income taxes to estate and gift taxes. So with that said, there is a general consensus that there will be a need for more revenue to deal with the nation's debt issues at some point. So let's consider the impact of the Tax Cuts and Jobs Act, which took effect back in, again, 2018. So of course, marginal tax rates overall were lowered at the time and continue to be at this point. Also, many popular deductions were either eliminated altogether or reduced. And so for example, taxpayers can no longer claim miscellaneous deductions, and the deductions for state and local taxes, which are also referred to as SALT deductions, that's limited to $10,000 a year. So combined with the fact that the standard deduction nearly doubled, almost all taxpayers, roughly 90% or so, now claim the standard deduction on their return. On a positive note, the alternative minimum tax, or AMT, has been scaled back dramatically. So according to the Tax Policy Center, only 200,000 taxpayers will owe AMT each year. So that's in comparison to before the tax law changes, where there were about 5 million taxpayers that were subject to the AMT every year. So with respect to gifts and estates, we're certainly in a favorable environment since most will not be subject to that tax. The Tax Policy Center expects only 1,700 taxable estates each year, and then that's down from around 5,500, under the previous tax rules. So lastly, because of the strict budget rules related to the passage of the laws, most provisions, including the lower taxes, are scheduled to expire after 2025. All right, let's take a look at key tax figures for 2023, most of which apply to 2024 as well. As a reminder, the top ordinary income tax rate under the prior rules, again, prior to 2018, it was 39.6% versus the 37% top rate now. Now, one area of significant change in the tax code is deductions, with the standard deduction nearly doubled. So more taxpayers will claim the standard deduction and less will itemize deductions on their return. Before the tax law, roughly a third of taxpayers itemized. And now going forward, tax experts predict that about 10% or so will itemize. Also, mortgage interest is now capped at $750,000 in debt, and that was down from $1 million before the tax law change. So for example, if you happen to have a $900,000 mortgage, you can write off interest based on $750,000 of that debt, but just not on the total amount because of that cap. Now, this debt can include a second mortgage, but the total debt cannot exceed $750,000 for the interest deduction. Also, interest on home equity lines of credit may still be deductible if the proceeds are used to either buy, build, or substantially improve the taxpayer's home that secures the loan. For more information, be sure to consult with your tax professional. So as I mentioned earlier, state and local taxes against the SALT deductions are limited to a total deduction of $10,000 from local property taxes, as well as state and local income and sales taxes. So to give you an example, if you have $12,000 in property taxes and $15,000 in state income taxes, you can only deduct a total of $10,000 on your tax return. Other deductions that were repealed include things like casualty losses, unless there was a federal disaster declared. Alimony payments are no longer deductible, and then therefore, alimony received is not considered taxable income. Also, moving expenses, except for members of the armed services. And then lastly, examples of miscellaneous deductions, which are now eliminated, include unreimbursed job expenses, certain membership dues, investment fees, and tax preparation fees. All right, so after the Tax Cuts and Jobs Act, fewer states are subject to the estate tax. And this is because the lifetime estate/gift exemption amount doubled to over $12 million per individual. So what that means is that a married couple can effectively shelter over $24 million in net worth from estate taxes. So of course, these rules sunset after 2025, when the exemption amount will revert to current levels that are adjusted for inflation. All right, then in late 2022, Congress passed an omnibus spending bill that included the Secure Act 2.0 Act of 2022. Now, this legislation builds on the original Secure Act, and just so everyone knows, SECURE stands for Setting Every Community Up for Retirement Enhancement from back in the Act of 2019. And so it expanded access to retirement plans, promoted participation, and also preserved savings. While some changes took effect in 2023, many will be phased in over the next few years. So there are roughly 90 separate provisions within the new law, including one that would only be available, again, if the employer updates their plan document to opt in, but that would provide employees with an employer retirement plan match if the employee is making payments on their student loans. Now, this provision certainly could be hugely beneficial to younger employees who are dealing with large student loan balances, again, if the employer decides to opt into that. Along with this new provision, let's take a look at some of the other key ones and their implementation timeframe. All right, so the original Secure Act raised the required minimum distribution age from 70.5 to 72, effective in 2020. And then the new law further extends the RMD age to 73 in 2023, and eventually to age 75 in 2033. So the delayed start date to RMDs certainly may be advantageous from a tax deferral standpoint, while also at the same time realizing that the delayed RMD starting ages could also present opportunities for planning through strategies such as a Roth conversions, which we certainly are happy to help you discuss. All right, so in an effort to provide more flexibility and promote the use of 529 accounts, the new law also allows unused 529 funds to be transferred to a Roth IRA, as long as it's in the name of the beneficiary. So while the annual IRA contribution limits apply and compensation is required, the normal income limits to determine if someone is eligible to make a Roth IRA contribution is waived in this case. Also, there's a limit of $35,000 over a lifetime for moving assets from a 529 plan to a Roth IRA, and the 529 must be open for at least 15 years. So currently, it is unclear if simply changing the beneficiary on the 529 or changing plans would result in sort of resetting of the 15-year clock. Not that most folks will overfund for their children or grandchildren's education due to the high cost, but if your child or grandchild changes their education plans for any reason, for instance, this could be something certainly to consider. All right, so while we're in a relatively favorable tax environment currently, what does the future hold? So taxpayers need to consider the risk of higher taxes for really three main reasons. So first, ongoing legislation efforts on Capitol Hill. Secondly, we have the expiration of these tax provisions at the end of 2025, which is coming up pretty quick. Lastly, there's the ongoing fiscal pressure that our federal government faces. So with these considerations in mind, the question we ask is, can there be steps taken in planning now to prepare for the risk of higher taxes, including if any of those steps could be started during this relatively short window of favorable tax rates? So to get a better handle on this fiscal pressure, let's consider pressures at the federal government level that may lead to a change in tax policy in the future. So the cost of servicing our federal debt over the next 5 years is estimated to increase by a whopping 89%. And again, that's really stemming from the higher interest rate environment that we're in now. So in addition, more federal government spending is on sort of autopilot, meaning that 70% of the spending is allocated to mandatory programs like Medicare and Social Security, or utilizes service interest costs on the current debt level. So in general, the percentage of mandatory versus discretionary spending has been increasing over the past decade or more. So lastly, according to the latest Social Security Trustee Annual Report, by 2034, the trust will be depleted. So now this means if nothing changed in the meantime, that the benefits would have to be provided solely from current receipts, money coming in, which would immediately cut benefits by around 25%. All right, so let's go ahead and transition to actionable planning considerations. With that said, I'm happy to turn things back over to John to explore some of these planning themes in more detail. So John, why don't you go ahead and take it away?
Okay, thanks, Kevin. And just take control here. Great. So, ultimately, we're going to talk about some different tax planning opportunities, things for you to consider. We'll start with maximizing deductions, taking advantage of these lower tax brackets. Kevin was talking about in 2026, everything changes. So you have to be cognizant of the fact that today's tax brackets are the lowest in history, and they're probably not going any lower ever. It could be extended. We don't know the political regime going forward, but pretty confident in saying they're not going to go lower than what they are today. And eventually, there's just some different reasons where there's going to have to be some increased taxes, and then we'll follow that up by different estate planning considerations. So this strategy that you are seeing on the slide is called lumping, where you do a certain strategy to try and get to the itemized deduction. So every tax year, individuals can either take the standard deduction or they can itemize. They get the higher of the two. Kevin mentioned the statistic that 90% of individuals are taking the standard deduction now, just because the standard deduction is so high. But if you can get over the standard deduction to the itemized levels, that's obviously much better, because the higher deductions, the better your tax bill would be. So this is an example of someone that's contributing $10,000 a year to charity in 2023, 2024, and 2025. So you've got 3 different specific gifts. Now, lumping, some people call it bunching as well, there's different names for it, is where you use a strategy. There's an investment called a donor advised fund, and you take the next few years of charitable contributions. So in this scenario of 2023, 2024, and 2025, that would be $30,000. And you put that $30,000 into a donor advised fund right now. Obviously, it's easier said than done than having that type of money laying around. So you have to have access to liquidity for your funds. But in a donor advised fund, you get the full deduction the calendar year you make the donor advised fund contribution. And you do not have to give the full amount that very next year. You can spread out the gift. So for instance, you could put $30,000 into a donor advised fund, dole out $10,000 the year you put it in, dole out another $10,000 the year after, dole out another $10,000 2 years after, and you could keep going. So you can fund a donor advised fund as much as you want. What that does is it basically switches you from a standard deduction in 23, 24, and 25 to an itemized deduction in 23, and then you're back to a standard deduction in 24 and 25. So again, in this example, 65-year-old couple donates $10,000 a year to charity. Let's assume they have $10,000 for a state and local tax deduction. And let's also assume they have $8,000 for mortgage interest. So if they just made the $10,000 a year charitable gift, they would not get over the standard deduction. So that's what they would take all of those years. But if they put that $30,000 and bunch it all into a donor advised fund in one calendar year, now they get to use the itemized deduction in 2023, which would be roughly $17,000, $18,000 more in a deduction than just the standard deduction. And then in 24 and 25, they go back to the standard, just like they would have been at anyway. But just that bunching or lumping donor advised fund donation, that would save about $4,000 in taxes. So you're doing all the same things, you're giving the exact same amount to charity, but you are trying to get to an itemized deduction in one calendar year. The other thing, just as far as since we're talking about a charitable contribution, is, I mean, you can see these checks on the slide. That's how most people give to charity, is they just write out a check. If you have a non-retirement account, you can't do this in retirement accounts, but if you have a non-retirement account, and let's say you invested $6,000 in ABC fund or ABC stock, either one, and that 6,000 grows to 10. Okay. If you were to take that $10,000 out of your account, the IRS would say, oh, goody, now we get to tax that $4,000 of growth. Instead, if you gift that investment to charity, the charity then sells the investment. Well, they don't pay tax on the gain because they're a charity. You get the full $10,000 deduction, just like you would have if you would have written out a check. And then you take the $10,000 check that you were going to give the charity in the first place, and you put that back in your investment account. So ultimately what that did was it eliminated that $4,000 taxable gain, that 6,000 to 10,000 difference. And then you move forward from there. So it's better to contribute from a non-retirement account from a charitable standpoint if you have that type of account with those types of gains. But that's just a planning technique that we consider. And then on top of that, you look at something like this type of strategy where you bunch or you lump a charitable gift all into one calendar year. The other tax strategy that we'll talk about here is called a QCD, Qualified Charitable Deduction. This is only for individuals that are 70 and a half or older. So if you're not yet at that age, you have to wait because the IRS requires you to be 70 and a half or older. It's not the calendar year you turn 70 and a half. It's the day you turn 70 and a half or beyond. So you have to be over 70 and a half to do this. It's called a QCD. But that's where you give directly from your retirement account to the charity instead of writing out a check. Okay. And by retirement account, I'm talking about an IRA, individual retirement account. Now, Kevin was mentioning earlier, required minimum distributions has been delayed. It's used to be 70 and a half, but now it's 73, moving to 75 in the later years. But they did not change the QCD directive. They kept that at 70 and a half. Whether that was a mistake or not, who knows, but it doesn't look like they're going to change that off of 70 and a half. So even though you don't have a required minimum distribution until 73 or 75, you can still do a QCD at 70 and a half or older. Now, the benefit of that again is if 90% of our country is taking a standard deduction and they can't get to itemizing, if you give directly from your IRA, you get that write-off, because normally you take money out of an IRA, you pay tax on it. As long as you do a QCD to a charity, they let you take the money out of the IRA and you do not pay the tax. So ultimately, again, that's saving you a check to write out and giving you a donation that you get to write off, and then you can take that money that you were going to give to charity and you can invest it in a non-retirement account, because you can't put it back into a retirement account from a contribution standpoint once you're retired, but that can go into a different type of investment account. So the rules on that, you have to have the check made payable to the charity, and not be made payable to you and then you direct it to the charity. It's got to be made payable to the charity. So we have a special form that you fill out, say who you want or what charity you want it going to. You can have as many as you want, dollar values that's specified. And then the check gets mailed to you and you give it directly to the charity. There is limits on this. The IRS put a $100,000 limit per account owner indexed for inflation. So that is a rule that we typically don't have to worry too much about, because people aren't giving that much, but just the way that the law was written. So again, ultimately, this is going to lower your adjusted gross income, because if you are past the age of required minimum distribution and the IRS is forcing the money out, like I know a lot of the people on this call are in their RMD years. This qualifies for an RMD. So if your RMD is $4,000 and you always give $4,000 to charity, you could do this QCD for $4,000, then you don't have to take out any more money. They allow you to use that as your required distribution and not be taxed. So it's going to lower your adjusted gross income, because you don't have to pay the tax on that IRA distribution. And there's other beneficial impacts on that as well. Like, can reduce your Social Security tax that you pay, reduce your Medicare premiums, because Medicare premiums are based on the amount of income you show 2 years prior. So there's a whole host of tax benefits for doing a QCD. But ultimately, it's doing what you would have done anyway and give to charity, just doing it in a different way through this qualified charitable deduction. So this is showing the 23 tax brackets. And again, those tax brackets didn't change, or the 10, 12, 22, 24, 32, that did not change for 2024. The ranges changed a little bit, like the 22,000 is now 23,300. The 89,450 goes up to 94,000. So it moved by about 5,000 up a little bit. But what you see on the right side of that tax fence is where tax brackets are going in 2026. Now, again, politically, they can change that. We'll see if that occurs. But what's written in law is the 10% bracket stays the same. The 12% bracket jumps up to 15. 22 jumps up to 25%. 24 to 28. 32 to 33. 35 stays the same, and 37 goes to 39.6. But you can see the ranges are getting squeezed on the right hand side. So you move up the tax table quicker, which is kind of a double whammy. Not only are you paying a higher tax bill because the tax bracket is higher, but you're also phasing into that next bracket quicker. So that's where we start to talk about this idea of a Roth conversion. If we know that money is going to be taxed from an IRA at some point in the future, even if you don't take out the money, it's going to be forced through that required minimum distribution program. do you take advantage of these lower brackets today? So it's not forced out at the higher brackets on the right. And that's kind of a case by case discussion. We would be going through that with you and seeing if it makes sense to you. But there's something called bracket fill, where you look at the bracket that you're in today and you see how much more money could I fill up in that bracket and not go to the next bracket. So for instance, looking at the 2023 table, you would be in the 22% tax bracket from 89,450 to 190,750. If your taxable income was 160,000, just throwing out a number, you could fill up that bracket with about $30,000 of IRA conversion. That 30,000 would then put you right up at the line here. You'd still be in the 22% tax bracket, but now you just locked it in. You know what you're going to pay. And I'm good at math here. 22% is better than 25. So that's this discussion on a yearly basis. You have until December 31st every year to do a Roth conversion. And we just want to look at different levels. We also have to pay attention to what that does to Medicare costs 2 years down the road for you. So we would be helping with that. But looking at these different tiers, it's a very popular strategy to do these Roth conversions because brackets over here on the right are not going lower, they're going higher. Some people think it's going to get a lot worse than what you see on the right. So that's just what's in law today. But we'll see what they actually change it to in 10, 15, 20 years based on some of those statistics Kevin was talking about. Right here is this red dotted line. This is an important tax number. At 250,000 of income, a new tax is added called the surtax, the Medicare surtax, and that's where they add 3.8% tax on your non-retirement account income. So again, we just have to be careful of that as a threshold as well when we're talking about conversions, but really that would be our job to help you understand how that affects you. So this just kind of talks about that Roth conversion strategy, topping off the tax brackets to lock in the taxes today so you don't have that in the future. The other benefit of doing that then is it's tax-free growth for the rest of your life. And if you don't ever spend it, it's tax-free to your beneficiaries. And for non-spouse beneficiaries now that they have to take out all the money in a 10-year period of time, once they inherit the money, it's much better to inherit a Roth IRA than a pre-tax IRA. So why is that? Well, in a Roth IRA, you could just hold the money for 10 years and withdraw at the last day of the 10th year. And the younger generation could get 10 years of tax-free growth if they want. If they inherit pre-tax IRA instead, it would be a tax mistake to hold that money to the last day of the 10th year, because now it's a tax explosion in that one calendar year. And if you inherit a pre-tax IRA, you've got to take out money little by little and spread out that tax versus inheriting a Roth where you can just wait to the last day of the 10th year. So again, that's not benefiting necessarily the current owner, but it's more an estate technique. Do Roth 401k contributions make sense? If you are in your accumulation years, pretty much every plan out there now lets you do either pre-tax or Roth contributions. And that just basically tells the IRS, do you want to pay tax now or do you want to pay tax later? And if you do a Roth 401k, you're saying, I'll bite the bullet and I'll pay the tax now at today's rates. So it's tax-free for the rest of my life and it won't get forced out ever. Again, that's a client by client conversation on whether that makes sense for a Roth or pre-tax. Last bullet point I wrote there, maybe alternative ways to fund Roth accounts even if income is higher. Again, if you are earning income, the only way you can contribute to a Roth is through earned income. But I don't want you to mistake that for a Roth conversion. If you have an IRA, you can at any time, whether you're making money or not in retirement, you can pick that IRA up and put into a Roth. That's called a conversion. A conversion is not a contribution. Totally different things. A contribution is where you're just writing out a check and putting it into your Roth retirement account. And for that, you have to have earned income. But if your income is above a certain threshold, which that threshold for married filing joint is $230,000. So as long as you're making less than that, and for individual, it's $146,000. As long as you're making less than that, you can contribute to a Roth. If you make more than that, you can do what's called a backdoor Roth, and that would be maybe a conversation for another day. But we could talk to any individuals that might be in that category on this webinar if that's of interest. Fun stuff. A lot of options. So from a estate planning standpoint, first bullet point, review existing trust to determine if changes are needed. I mean, ultimately, every once in a while, we will see a trust to be named as a beneficiary of a retirement account, and it's really important that the trust has the language written that allows for yearly contribution if the beneficiary chooses. There are some old trusts that were written that said the beneficiary can take money when it is required to do so, because the old law used to have yearly required distributions for inherited for beneficiaries that inherit a retirement account. But now that's not so much the case. And we want to make sure a trust is flexible, that if they inherit a pre-tax IRA, they can take out money and spread out those withdrawals over a 10-year period of time versus just taking very minimal distributions and then a big lump sum at the end of the 10th year, which would hurt them from a tax standpoint. So a lot of estate attorneys are updating these trusts if they wrote them the incorrect way, but the onus is on the individual that has the trust. So we just have to make sure of that. Next bullet point, be mindful of state death taxes. Gosh, death taxes are fun. So right now, from a federal estate or death tax standpoint, not a lot of people have to worry about it because the threshold is in the 13 million range, 13,610,000 to be exact. And both spouses get that. So you add the two together and you got a $26 million estate tax exclusion. And there's not a lot of estates over 26 million. But number one, that estate tax threshold is going to come down, which I'll show you on another slide here in just a second. But on top of that, what I was just explaining was the federal death tax. A lot of people forget about the state death taxes. Now, being in Wisconsin here, a lot of you on this webinar are in Wisconsin. Wisconsin matches the federal threshold, so don't necessarily have to worry about here in this state. But since we have clients all over the place, if you're in a state like, what's the worst one, Oregon, they have a $1 million state death tax exclusion. So if you die with over $1 million, whether that be in your insurance, death benefit, your retirement accounts, your non-retirement accounts, home value, if that adds up to more than $1 million, the state of Oregon will tax you at 16% for anything above that. There's different ways to plan around that, but have to consider that state death tax as well as federal death tax. Some states around here, Illinois has a $4 million estate, or sorry, $4 million estate death tax. Just I'm trying to think of what Minnesota has $3 million state death tax. So those are just if you have state residents outside of Wisconsin, it's kind of a one-to-one conversation that we want to have to be wary of that issue. Next bullet point, plan for low cost basis property. So there's something called a step up in basis, where if you have an investment in your non-retirement account that has a very large gain, like let's say you put $1,000 in NVIDIA, that $1,000 has grown to about 500,000 today. It's not exactly true, but it seems like that stock just keeps going up. If you have a very large gain in a non-retirement account and you take out the money, the IRS gets to tax that gain. If you die and you pass on that asset, nobody pays tax on that gain because of the step up in basis. So unfortunately, we just had this client case that the client unfortunately just died 3 weeks ago, but they had a very large gain in a stock. And they were thinking about selling that a few years ago, but we had this conversation with them to say, well, if you really can get the money somewhere else, rather than you paying tax on this huge gain, we might want to just hold on to it, and then your kids won't have to pay the tax on the gain. In this case, the spouse, they passed the stock on to the spouse, and the spouse got to step up as well, being in a community property state like we are in Wisconsin. So those considerations are just there to consider the fact that you want to use these tax benefits to your overall family and the state's benefit. High net worth families may want to consider a gifting strategy for the lifetime exclusion because of that sunsetting. So what I mean by that is we know that $13 million federal estate tax or death tax is going down to around $7 million in 2026 when this sunsets, and that's still a good amount. It's a pretty large estate. But if you were in this range and now you are in the estate tax threshold, you do different gifting strategies, different charitable strategies, different trust strategies to try and get that money out of your estate, so it doesn't get taxed at the federal estate tax percentage, which is 40%. That's worse than a lot of the state taxes, which tend to be around 10 to 20% for state estate taxes or death taxes. Talked a second ago about that new 10-year rule for inherited retirement accounts and just how beneficiaries have to be careful on how they stretch that out, whether you're inheriting a Roth retirement account or a pre-tax retirement account, two totally different things from a tax nature. And you just have to have a plan on how you're going to take those payments on inheriting a retirement account. Our goal is to just always have tax efficient IRA distributions, whether it's for the owner or for whoever is going to inherit the money, because the owner doesn't spend it all. So Roth conversions today for the owner can benefit those types of distributions later on. They can benefit because tax brackets will increase over time, and you can lock in your tax brackets today. The other thing that sometimes people don't consider is typically spousal couple doesn't die the same day or the same calendar year. And when one spouse dies, that next calendar year, the other surviving spouse now is in single tax brackets instead of joint tax brackets, which are more favorable, yet they still have all the same money. Still have all the same required distributions. And that's called the widow penalty, widower penalty. It's just the fact of life that, do you plan for that? Do you look at that type of tax regime that the surviving spouse would be in. Other strategies to consider, leaving an IRA to a charitable trust for those charitably inclined. Charitable remainder trust is an investment vehicle where you can put the beneficiary of a retirement account through this charitable remainder trust. You can have your family members be the income beneficiaries of the charitable remainder trust. And that basically allows them to spread out the money much longer than 10 years. But at the end of the time frame that the beneficiaries got the money, the balance goes to charity. So that it doesn't stay in their name. So there's rules on how much they can take out, but it allows them to spread out a pre-tax IRA withdrawal over a much longer period of time versus 10 years. If individuals wanted that money to go to charity or want to make a charitable gift anyway. Life insurance is another way to leave tax efficient money to the next generation. So we have some people taking out their required minimum distributions and using it as a life insurance premium, leveraging that up. A lot of different unique techniques you can do there. So I kind of talked about death taxes a bit, but just know if you're not in that threshold, estate planning is more than just the taxes. Always want to make sure beneficiary designations are up to date. You can change those at any time, but once you're gone, you're gone. And it's however you have the beneficiaries listed. And in 24 years I've been doing this, unfortunately, I've seen individuals not update their beneficiaries. Usually it's not the individuals that work with us because we always talk about updating beneficiaries, but somebody that's coming on as a new client that they're dealing with something like this. So a revocable living trust, different ways to make sure property is outside the probate system, flow directly to the trustees. Having healthcare proxy, financial care power of attorney, having all of that documentation in your estate plan is important. And certainly if you have minor children, make sure that guardianship is set up correctly. The last thing, just to touch on from a standpoint of business owners, I'm not going to go into this too much depth, but if you do have a business and it is structured as a sole proprietorship or LLC or partnership or S corp, the big tax benefit is this QBI, qualified business income deduction, which can be up to 20% of your business income. And there are rules that you have to follow if you're a what's called a specified service trade or business, an SSTB, as the IRS likes to use the acronym. But basically that's for any types of jobs in the services field. So healthcare, law, accounting, performing arts, financial services, just any type of business where you have services. There's some different rules you have to follow, but ultimately this 20% qualified business income deduction, you can get that 20% deduction up to certain income levels, and then there's phase outs if you're in that SSTB section. But for non-SSTB businesses, which is probably a majority of small businesses, it's just a nice deduction to take advantage of and to know about, that you write that off of your taxes. So just in general, closing thoughts, we're not trying to shy away from paying taxes. We just don't want to leave the IRS a tip. So that's my last little corny joke. But it's a very important part of planning. We're constantly talking about making sure that you have a proper distribution plan, proper tax plan. It's just a part of overall comprehensive planning. We're not only just looking at investments. We're not only just talking about retirement, making sure you're not gonna run out of money. We wanna factor in taxes and making sure you're making the right tax decisions. And ultimately, we wanna work with your other tax professionals if you have one, because they're just another team member for you and making sure that we take advantage of those taxes. But we find a lot of times from a accounting or accountant standpoint, accounts are more about paying the least amount of tax in a certain calendar year. We really want to think about paying the least amount of tax over your aggregate retirement, not just in one calendar year. And that's where we're constantly thinking forward on where tax bracket's going to go to, what might be forced out in the future, how might that affect everything else with future income like Social Security. So that's where we just try and provide that benefit. We've got certain software and things we can review with each of you if that's of interest. And I know a lot of people on this call, we've already had those discussions. So I am going to stop sharing